The Bear Roar Special Edition series, Bandwidth, serves as a platform to celebrate the people and stories of Dan's book, Bandwidth, the untold story of ambition, deception, and innovation that shaped the internet age and the dot-com boom. The story covers the epic journey of the creation of the internet backbones, the building of the early competitive fiber networks in the 1990s, the bandwidth boom, bust, and resurrection, ending in 2020 when Dan's company, Zayo, was sold. The book is available for pre-order on Amazon and Barnes & Noble with a February 2025 release date. Head to dan-caruso.com/book for more details. On this episode, Dan chats with Nick Del Deo, who currently serves as the managing director at MoffettNathanson, a leading independent equity research publisher. Dan and Nick's professional paths first crossed during the Zayo IPO roadshow in 2014, when Nick was a young, talented analyst reporting on Dan's company, Zayo. Nick has grown in his career analyzing telecom companies, infrastructure investments, and market trends. In this episode, Dan and Nick discuss the rise and fall of the telecom industry, the future of digital infrastructure, and touch on the opportunities and challenges facing companies in this space. Nick's insight provides a deeper understanding of where the telecom sector is headed. Let's book the bear to kick off the conversation.
So Nick, I'm going to start at the first time that I remember that you really popped squarely onto my radar, and that was during the Zayo IPO roadshow. When I woke up one morning, my recollection is that I was in San Francisco and getting a cappuccino before we were starting our day's worth of roadshow events, and I get an email from you, specifically from your firm, with the headline being something like Superman versus Batman, dark fiber versus towers. So tell us about that piece there. What inspired you to pull that together, what it meant, and the fact that you guys launched that during our roadshow, kind of what the thought process is going on there behind the scenes. It was very exciting part of the roadshow, and want to relive that experience.
All right, cool. Well, Dan, thanks for having me on the podcast. Really appreciate it, and congrats on getting this off the ground and the new book. Yeah, so listen, that was it was an interesting time in my career too. I had recently launched as an analyst, starting with the fiber space. I'd later cover.
How old would you have been roughly at that point?
So 10 years. So that would have been 2014. So I'm 45 now. So that would have been 35.
Yeah,
45.
So fairly early in your career as kind of an analyst.
Yes. And as it happens, so like you said, it was during Zayo's IPO process, during your roadshow. So most of the other analysts who were going to be covering your stock once you went public were affiliated with investment banks. Mm-hmm. And I think a lot of them were doing work with you at the time to bring you public. So they were not permitted to publish on your stock. They weren't allowed to talk about you until a certain number of days after the IPO. But I had a lot of clients who were asking questions. What do you think of this Zayo company? What's this dark fiber business? Is this just a holdover from the bubble? Is there going to be something wrong with it, or is there something legitimate here? I hear the CEO is comparing his dark fiber business to towers, which is pretty strong statement. What do you think about this? So I said, you know what? I plan on covering the stock anyway, so why not be responsive to my clients and get some thoughts out there sooner rather than later? That was the thought process behind it.
Maybe talk about as being an independent analyst, like what does that really mean, particularly in the wake of the telecom meltdown, the dot bomb? What did it mean to be independent? Why couldn't the other firms have their analysts cover us during kind of our IPO process? And then a little bit about your firm itself and the depth and breadth you would go into when you would do a piece, did the dark fiber piece.
Yeah, well, it may make sense to step back a little bit and talk about what it is a sell-side analyst does versus buy-side and the relationship there. Mm-hmm. So, when you hear the term sell-side and buy-side, buy-side tends to refer to money managers. So that could be a long-only money manager like a Fidelity or a Wellington or a Capital Research. It could be a hedge fund, pension fund, somebody making investment decisions. And they'll oftentimes lean on sell-side analysts or the sell-side industry to help them make investment decisions. So we write research on public equities, to help inform their investment processes. And typically, an analyst will focus on a particular market niche. So our firm, MoffettNathanson, focuses on TMT. The founding partners, Craig Moffett and Michael
And
Nathanson.
TFT means telecom, media, and technology?
Yep. Tech, media, telecom. Yes. So our founding partners, Craig Moffett and Michael Nathanson, were two of the, to be frank, two of the best analysts on the street. Craig covers cable, satellite, and telecom. Michael covers media and internet. So, a really good brand. A lot of us worked together before founding MoffettNathanson, which is back in 2013. We worked together at a firm called Sanford Bernstein, which was another research firm, kind of well known for putting out long-term, kind of deep dive, fundamental type research. Mm-hmm. And it was also independent. It wasn't affiliated with an investment bank. So a lot of the larger firms, think Goldman Sachs, Morgan Stanley, UBS, Bank of America, have sell-side research operations, but they're affiliated with investment banks, that help companies raise money, do M&A, and so on. The sell-side analysts at those firms can't work too closely with the bankers, but there are rules to minimize potential conflicts of interest. You wrote about this in Bandwidth. There were some unsavory sell-side analysts back in the day that sort of promoted stocks that they knew weren't fundamentally sound companies for the hopes that their companies would get investment banking business, which can be quite lucrative. So there are rules in place to try to minimize that.
And those rules got put in place in the wake of
exactly
what happened, both in the telecom meltdown, the Enron story, maybe the .com. So analysts who were not just part of the same firms
mm-hmm.
as the investment bankers, but there was a big blurring of lines between, was the analyst really putting out objective advice, analysis about these companies, or were they really serving to promote those companies mm-hmm. in exchange for those companies awarding them lucrative investment banking business?
Exactly.
And there was plenty of reason to think there was a big blurring of lines in many cases that got completely out of control. And in the wake of the meltdown, a new law was put in place called Sarbanes-Oxley mm-hmm. that created more rules between what you can and can't do when it comes to presenting what's supposed to be objective analyst coverage if you're part of a banking firm.
Yes.
You guys were created in the wake of all that happening, it sounds like as a spin out in 2013, did you say?
Yes. So we launched MoffettNathanson in 2013. And we are, again, we're a boutique, we're independent. Today I think we only have 20.
How do you get paid? How does your firm make money?
Yeah, so that's a great question. And the way that we get paid is a bit different than a lot of our competitors. Mm-hmm. So most sell-side firms will get paid through commissions. So essentially what they'll do is they'll give out their research to as many folks as possible. And then the salespeople will call up those clients and try to get them to do trades with the firm. So maybe if somebody writes a report on AT&T and the client likes the report, they'll execute a trade, possibly with AT&T shares through that firm and generate commissions to indirectly pay for the research. Mm-hmm. We have a pure subscription model. So we don't have a trading desk. If somebody wants our research, they pay a quarterly subscription fee. And we have a couple different tiers of service. We have some more expensive than the others. But it's a much simpler model, much more direct linkage between how people view the value of the research and the quality of the work and what they're willing to pay for it versus the indirect commission model. Mm-hmm. Simplifies our operations. It enables our salespeople to focus a lot more on serving our clients well and finding new clients. And the fact is, without kind of tying it back to your earlier question, we don't have a banking business, so we are truly independent. No potential conflicts, whether direct or indirect. And I think our clients have really come to trust our work for being fair and balanced. Mm-hmm. Something that I think has served us well in the market.
Yeah, and when you were at Bernstein, was Zayo on your radar there, or were you involved in different sectors?
No, so at Bernstein, I was actually working as Moffett's associate. So typically, a team is structured with a senior analyst and a handful of associates that work for the analyst. So I'd been at Bernstein for about 5 years working with Craig. And Bernstein's model is one where they typically hire former executives or consultants to the industries that they cover to be the analysts. So, after 5 years, I hadn't had a background in telecom before joining Bernstein. So I'd kind of reached the end of the road there. But it happened to be at the time when Craig and a handful of others were thinking of leaving. So the idea was, well, Nick, we value your work. We think you could be a great analyst. Come with us and cover adjacent sectors. So Craig continues to cover cable, satellite, and telecom. But we saw internet infrastructure, towers, and data centers as adjacent coverage that could build on what I knew and kind of fit in well into a broader offering for our clients.
Great. So you started as an analyst, 5 years from 2013. So just a little bit after Zayo got started, but a few years after the big wreckage in the industry.
Yes.
If you could put yourself back into when you first started getting exposed to the industry, this is probably asking a lot, and you are looking backwards in time and saying, what happened when I was in college or when I was in, maybe even high school? What did you surmise about what happened in the late 90s, in the early 2000s, both the big boom and the bust, and where that all came from? Was that something that you were able to get your head around, or was it kind of far enough in the past that you could see it happening?
A little bit. A little bit. It's funny. So I graduated from college in 2001.
Okay.
So I went to the University of Pennsylvania, and I remember at the time, it was very popular among the students in the business school, Wharton, to also get like a master's in optical engineering. That was a popular thing at the time. And coming out of school, everybody was looking for jobs either in investment banking or at telecom firms, which was kind of fun. I remember I had a management class where we had a team project, and we did something on Nortel. And somebody else did something on Cisco. In fact, the teammate had an internship at Cisco, and it was very, very cool at the time. So it wasn't something that I ever thought I would be involved in, but certainly it was certainly part of the zeitgeist at the time. Coming out of college, I worked at a couple of different hedge funds where I was a generalist. So I wasn't focused on any particular industry, but I had looked at a couple telecom related firms that had bombed, where essentially their market values were less than the net cash they had on the balance sheet. So I remember looking at a few firms like that and doing a few trades along those lines. But again, as a generalist, not as somebody who was specializing in the industry. When I ended up in telecom was basically an accident. I had been working at Morgan Stanley previously, and the fund I was part of got shut down. And I was looking for a job. And, I think Bernstein had a great reputation. And I thought at that point in time, that it was important to kind of start to specialize in a particular area rather than being a generalist. And it just so happened that Moffett had a seat available, and that's where I got slotted in. But, I've really, the way the businesses work really made sense to me. I had a great relationship with Craig. And that's kind of how it stuck. But before that, again, my recollection of the bubble times is really just, a few experiences in college and a couple of stocks I looked at thereafter. In looking at the industry in a more fulsome way, having started at Bernstein, a lot of the companies that had crashed at the time, like a level 3, were really on the periphery of what our clients were looking at. They were much more focused on the big incumbents like AT&T or Verizon, or on the cable companies, much less on the fiber operators. And it really took a few years before they started to regain prominence. I think with Zayo driving a lot of the way of the change in how people perceive them.
Yeah, because part of the opportunity that led to the creation of Zayo was that the broader investment world wanted nothing to do with companies that had fiber networks because of how much value destruction took place, and the elements of the value destruction, the elements of deception, of all this hype that was followed by broken promises. And let's face it, a lot of investors lost incredible amounts of money, and they didn't want to go back there. I likened it to drinking too much tequila. You have this tequila hangover, and the last thing you see for a long time is tequila. You don't care that the problem wasn't the tequila itself, at least tequila in general. It was how you drank your tequila and what tequila you drank. And, but it didn't matter. You just want to stay away from it for years to come. So in that time frame, it took certain types of investors to want to pay attention to telecom. They have to be specialists, or they have to be the kind that look for industries that are in complete turmoil to look for investment opportunities. And your clients were probably not, of that nature. That wasn't, who they were as clients of your firm in that time frame.
Yeah. I mean, look, their perceptions of this part of the industry were really grounded in what had happened in years prior.
Yeah,
absolutely.
Good reason.
Yep.
Very good reason. Okay, so when did you start to spend more time on the category of telecom that were fiber providers, were companies like Zayo and kind of the ones regrouping from the mess of the past?
Yes, that would in 2014. Okay. So when I launched as an analyst, the first two companies I covered were Level 3 and Cogent, and then Zayo several months thereafter.
Gotcha. Okay, so let's get back to our earlier conversation. Sure. So you're starting to focus on Zayo. Your clients are asking questions. We're going to go public, and you start to prepare this piece. So walk us through kind of your thought process as you hold that together and the thesis that you formed around it.
Yeah, well, again, at the time, I think there were a couple key questions I was consistently getting from clients who were thinking about investing in Zayo, or at least wanting to understand it, so they had some sort of frame of reference for when you did come public. What is the dark fiber business model? What does it actually mean? How does it compare to tower leasing? And what are the puts and takes we should think of? I see Zayo has pretty substantial CapEx. How should we think about that in terms of growth CapEx versus maintenance CapEx? So I think, those were some of the key topics that clients were asking me about. And, what I've found over time is that if you have enough clients ask you a question, you better write about it, because that's what people are curious about. So
your customers.
Yes, exactly. And, in this case, we have very, very smart customers. Truly a very insightful, very sharp people. So again, if they're looking at something in particular, that's a great clue that it's something that we should look into and publish on. So, I knew a fair bit about the tower industry. So that was a great starting point for considering kind of the fundamental puts and takes of tower leasing versus dark fiber. I had learned a lot about dark fiber when doing my initial research on Cogent and Level 3. So obviously, it was a decent revenue stream for Level 3, and Cogent's whole network at the time was based on dark fiber. So I kind of knew the ins and outs there. And from a CapEx perspective, one of the things that I always appreciated about Zayo, it actually turned off a lot of analysts, interestingly enough, but I found it really interesting, was the amount of information you published, in terms of stratifying how your bookings related to your CapEx needs, to the associated revenue and the incremental costs and so on. So we could take a lot of that information you shared and actually undertake the work of trying to understand those linkages and get a better idea of what Zayo's cash flow potential would be in a more typical state versus when it was investing heavily up front to build out its network or to integrate assets. So those were what I really focused on in that initial report. Trying to hit on some of the key questions that the clients were asking ahead of the IPO.
Yeah, the reason I was transparent, some would say to a fault, and maybe I would even agree with them, that probably took it to the extreme more so than I should have or needed to, perhaps. But the reason was because of the industry's past and the complexity of how financials worked relative to value creation. So thinking about the past industry, what we were doing could have easily been commingled with past practices that were done that sounded similar, but were done for the wrong reasons. In the past, they were done to create a facade of value creation as opposed to really creating value. Yet the stories that were being told didn't sound altogether different than what we were talking about. So I felt it necessary to provide data so that an analyst who was willing to do the work, an investor who was willing to do the work, could start to understand how the business model really worked, what we were really doing, and that it was being driven by kind of an understanding of value, true long-term value creation. Whether we're always successful or not is more of an execution question. But what we were doing was we weren't trying to deceive or fool or trick investors into thinking there was value there, so our stock would go up and we could sell at a higher price. And so I wanted to give them the information, but it also was from the perspective of wanting to keep us honest. It was almost like crowdsourcing the analysis, so that if we were missing something, or if we were getting caught into the same traps that might have caught people in the past, people could hold us accountable in real time so that we could course correct before we started doing things that were wrong. Kind of bring that to our attention, or at least we knew that it would be brought to our attention quickly, so I could get help from a broader group of people to help us steer the ship the right direction. So those kind of were what was feeding the desire to be so transparent. A lot of my investors were not entirely comfortable with that. They loved it when we were private and sharing it with them. They valued that tremendously, but for good reason. They were queasy about doing the same when we were transitioning to be a public company. But I'm glad to hear you appreciate that. So let's switch gears a little bit and talk about other reports that you published. Doesn't matter exactly what segment of the industry, but what reports did you publish over the last X number of years that you feel were most creative, most impactful, that you were most proud of? What might be 2 or 3 or 4 of those?
That's a good question. I would say, I thought when I first started covering the towers, I thought that was pretty rewarding. So that was probably back in the 2016 timeframe. And today we all think of the towers as having, a phenomenal business model. One of, if not the best in the broader telecom space. The predictability of the cash flows.
Well, I think you described it back then as so on. Perhaps the best business model ever created anywhere.
Yeah. I'd probably limit that to telecom. There's some other good businesses out there, but it's a damn good one. Yeah. But it's funny, at the time that I started to dig into the towers, there was a lot of skepticism about the durability of the business model. And questions that seem almost silly in hindsight, like, is Wi-Fi going to replace towers? Are small cells going to replace towers? Right around about a week after I launched, I remember Sprint came out saying they wanted to move from macro sites onto government land or into utility rights of way to save money. All these kind of silly arguments that really weighed on the valuations of the stocks, which were demonstrably incorrect. So I thought, the ability to go out and publish reports that really emphasized the durability and permanence of the model, and how attractive the opportunity was that the market was giving investors, being able to call that out, I think was very helpful to clients and very rewarding over time as the stocks outperformed. That was a good one.
And they went from trading in the teens, sometimes even the lower teens, from EBITDA multiple.
Yes.
So now they're trading in the mid 20s. Is that right? Or where are they trading?
Yeah, I would say, again, around the time I launched, they were probably in the mid teens, multiple of EBITDA or AFFO. At peak a couple years ago, admittedly when rates were, 1% or whatever they got down to, they got up to about 30 times. So about a doubling of the multiple, plus the underlying accretion in the results over that time. Now they've had a couple rough years, with rates having jacked up, and with the initial 5G deployment cycle having slowed down, but they still probably trade in the low 20s. Mm-hmm. So even if you were to simply look at what they were, call it 7-8 years ago versus where they are today, it's a 50% bump in the multiple plus the underlying improvement in the business. So a pretty meaningful multiple expansion. Yeah, I'd say more recently, earlier this year, there's a short seller, Hindenburg, He was known for taking down companies with Adani in India was a big target of theirs. But they wrote a short report on Equinix. I'm sure you know Equinix very well. Equinix, sort of an interconnection focused data center model. It's where networks go to exchange traffic with one another. And over time, you've had cloud service providers come in, enterprises, content, digital media, and so on to form these really interesting ecosystems, sort of a network effect in a tangible form. So it's a really interesting business model for Equinix to serve as really where everyone exchanges traffic to comprise the internet. And Hindenburg wrote a short report arguing that Equinix was engaging in accounting manipulation or accounting fraud. The business model was flawed. They were overselling power, blah, blah, blah. And those arguments were incorrect. And I think you could kind of demonstrably go through and say it's wrong for XYZ reasons, pick through the report, even though it was, again, a very high profile short seller. So I wrote a report that kind of articulated not just why it was wrong in most cases, but how the arguments Hindenburg was making actually illustrated that they weren't familiar with the business model as opposed to having some brilliant insight. I just,
was there any backlash that came your way when you did that?
I'm sorry, was there any
backlash that came your way when you went against?
No. I mean, clients were certainly interested. I never heard from Hindenburg.
Yeah. How was the stock affected by Hindenburg, and then what happened after the dust?
Yeah, so in the immediate wake of the report, it traded off quite meaningfully. I forget the exact numbers, but it might have been in the 8 to 10% range, something like that. And then the U.S. Attorney for Northern California initiated an investigation, as did the SEC. So Equinix reported that and then basically said, we're not going to say anything until we get this sorted out. So the board had an independent investigation done. But what happened is, with each passing day, with each passing week, the company was silent and investors started to worry. And it got to earnings time and the company passed its normal earnings date, said nothing. So people are thinking, oh, shoot, is something bad going to come out of this? And sure enough, one day the company reported earnings and had a call and basically said, we've done a pretty in-depth internal investigation. Nothing there. We filed our SEC, our 10Q with the SEC. We signed it. We don't want to go to jail. So take faith in that. But yeah, so I think, the company still, I should say that the U.S. Attorney and the SEC still have to wrap up their investigations. But by all accounts, this is kind of over and done with. I think, knowing the business well enough to be able to articulate a stance like that in the face of a lot of investor concerns and skepticism from a high profile short seller was pretty rewarding. I think I'll give you one other example of a good report or series of reports. I'll point to the commercial wireline space. So commercial wireline is a big part of AT&T's business, Verizon's. It was all of Zayo, it was all of Level 3s and so on. It was an important growth engine for the cable industry. But I would say, most investors and certainly almost all analysts kind of thought of it in very atomized terms rather than aggregating it and looking at the market was doing, how the market was performing in aggregate and the key themes there. I think in part because it was spread across multiple firms. I think that the coverage universes were split up. So not everyone covering AT&T would cover the other names to be able to aggregate the information. So over the years, I've spent a lot of time creating a market model to show the growth of the segment and better understand it and write reports to talk about its performance and outlook. And it's been, to be frank, my views have been fairly negative in aggregate, more so for the incumbents. You have fiber-oriented players without legacy revenue streams that are better positioned, cable companies taking share better positioned. But it's been sort of it's been a long-term call. I recall it was in 2016. The market had historically grown at, call it, a 1 to 3% type rate. And suddenly in 2016, we saw a dip. And I thought, oh, that's kind of interesting. So I remember writing a report on it at the time saying, the case of the missing revenue was the title. Wasn't quite sure what was going on, but I thought it was an interesting call out. And since then, the growth rate of the industry has gotten worse and worse. And it's now shrinking in aggregate at, a 3 or 4% clip. And it's kind of been an evergreen source of reports and insights for clients. Because consistently over time, all the participants say that they're going to either return to growth if they are, the incumbents who are declining, or accelerate the growth if they're in other niches of the segment. But that hasn't, it's never transpired. But digging into themes like, technology conversion cycles like MPLS to SD-WAN that have played out over time, the degree of competitive intensity, cloud substitution, things like that. I think it's been an opportunity to take a very large but perhaps misunderstood or underexamined part of the industry and shed light on it and help investors better understand how that portion of the businesses they cover are going to perform.
So I'm going to come back to that in a little bit, but let me hit a couple tangents.
Sure.
One is small cells. Let's start with small cells. Small cells were described as kind of a trend that was going to be significant. There was going to be all these small cells deployed. They would need fiber fed to them. Mm-hmm. We at Zayo and many others were doing these large deals with wireless carriers in anticipation of putting this infrastructure out there that would behave sort of like the tower model in aggregate, mm-hmm. because you would get first tenant advantages, build out a network, and be able to use both the fiber and the small cell infrastructure to get second tenant economics. So we all bought into that. We invested a lot of money as an industry. Crown Castle even started to buy up fiber companies, yet the small cells never played out the way I think a lot of folks thought it would at the time. As you reflect on that whole small cell trend, where were you at during the entire process, and how do you think that we as an industry kind of overreacted to that opportunity? I think it's safe to say, and in some cases, including I would say Zayo, paid a pretty decent price for that. Maybe in our case, smaller than in other cases. I think maybe Crown was probably the biggest, ironically, the biggest, loser in betting in favor of small cells being a really big deal, and it just never panned out. What's your thoughts on that? And do you think small cells have a future, or do you think that has come and gone, and they'll have a place, but a small place in the overall infrastructure of the wireless network companies?
Yeah, I think it's what you just articulated at the very end, which is they're going to have a place in the infrastructure, but modest. I was always a little more or more conservative on small cells than most, and I would say that how that part, or I'd say small cell growth has turned out to be even less robust than what I would have expected at the more conservative end. Mm-hmm. And looking back, it was really, I think it was really two things that drove that. The first is, when most people would think about small cells or the opportunity, they would think of it more from an engineering perspective and say, small cells are the logical conclusion for cell splitting. We think the carriers are going to need X number of small cells to serve, Y markets. Those analyses didn't necessarily take into account the economics appropriately, right? And so I think what those analyses missed is that from a carrier perspective, it's always dramatically cheaper to deploy capacity using a macro site than a small cell, to deploy on a tower rather than a small cell. You can cover a much larger area, you can do so more efficiently. The unit costs are much lower. With small cells, there are substantial costs to pull the fiber to all the street lamps you need to. You cover a much smaller area. The construction time frames are much longer. So, historically, to the extent that the carriers continue to have access to additional spectrum, it was much easier for them to layer that spectrum onto existing towers and augment those cell sites than it was to put up small cells. So I think it was So again, the first component I think was sort of the engineering versus the economic angle. Perhaps not putting enough weight on the economic side from a carrier perspective. And the carriers don't necessarily have the most robust financial profiles. That's very important for them.
Yeah, and I think that's correct. And you can look at it from different vantage points from the wireless carriers who were asking for large small cell solutions and pushing for pricing, which you as a provider can only get comfortable with if you thought this was the first tranche.
Yes,
of small cell needs with several more tranches to come. And when the several more didn't come, I think there was I would have never agreed to that contract.
Yes.
If the projections that I was relying on were incorrect, but because of the length of time it took to build these out, that happened over a 5-year period, not a 5-month period.
Yes.
When it became clear that maybe there wasn't these new waves coming.
And the other point, on the lease-up perspective, I think small cells suffered in two ways relative to towers. Because like you were saying, you need the lease-up to make the math work. One is that no carrier's small cell needs perfectly overlap with another's. So, if you think about tower infrastructure and you're covering a relatively large area, it's easy for carriers to find locations where they can co-locate on the same tower and have that make sense for all of them. With a small cell system, oftentimes maybe Verizon needs coverage on a particular side of town. AT&T might come in later and say, I need some of those locations, but I need it more over here because it's much more granular look at the network and coverage. So, you continually have to put more money into the system to get the lease up. It's not as not a direct as relationship between lease up and capex as you see on the tower side. But you also have the dynamic where AT&T and Verizon have their own wireline networks. And I think over time have been more willing to kind of build in-house and think of themselves as their own neutral host to make the math work. I think Verizon's really been the biggest proponent of that, where they said, and I think they call it Verizon, or they call it their One Fiber Initiative is the name.
Yes.
And the idea is, from their perspective, they say, well, if we're smart about it, instead of acting as a siloed business, we can construct fiber that we can use for small cell backhaul, for macro site backhaul. We can hook up some new enterprise buildings out of region. Maybe there's some wholesale traffic that we can bring on net. If we do that ourselves, we can make the math work better than if we were to lease from someone else. So to the extent that Verizon and AT&T have a presence in much of the wireline presence in much of the country, they can make the DIY math work. Mm-hmm. So when you think about the potential lease up,
that's what you said. They can make the math work. Certainly they can make it work on a spreadsheet.
Yes.
And rationalize doing exactly what you said. Whether the math really worked or not is a different and hard to answer question, as evidenced by Verizon taking a huge write-off in their Verizon business segment. How much of that was because they did try to put a lot of capital work on the presumption that they would have financial benefit from that, and maybe didn't have nearly the financial benefit that they thought they were going to have. But you're right. Once they reach that decision, second tenant economics get compromised for those who built out a small cell network for, say, mobile. And if AT&T is somewhere in between, again, it's hard to get the concentration of multi-tenant economics to work.
I think that's exactly right. And you've actually seen Crown Castle, which is the biggest small cell vendor, a couple months ago as part of their strategic review, prompted by Elliott. They've actually indicated they're really not going to build greenfield small cell networks anymore. Yep. Which is it's a pretty stunning change for what had been a key what was expected to be a key driver of their business.
Yeah, what's interesting is how different a path Crown took from, say, American Tower. Mm-hmm. They just took completely different directions, whereas Crown, bought into the, hey, we can take our business model, extend that to being owner of fiber networks, spent quite a bit of money, over $10 billion investing in fiber networks. Some say over $15 billion, including what they spent, organically. Whereas American Tower didn't go that direction, yet did stuff on the data center side. So chose two different paths forward. And, with the benefit of time, you could say one was a better answer than the other, at least as you sit here today. I guess that could change in the future, but
absolutely.
It didn't work out so well for Crown, and it did work out well for American Tower. Is that a safe conclusion?
Yeah, I think so. I wouldn't let American totally off the hook. They did acquire CoreSite, which I think has worked out well. They bought ahead of a lot of the AI related demand and pricing benefits we've seen. And CoreSite was one of the better data center businesses out there, like Equinix, interconnection focused. And CoreSite actually generated the best returns in the data center space, at least the way that I did the math. American, though, they also pushed very heavily into a lot of emerging markets to export their tower leasing model, right? So they, historically Latin America, India, Africa, Europe. So really global portfolio. You could say, you say the sun never sets on the British Empire. You say the sun never sets on American Tower. It's a truly global business. But some of those emerging markets did not do well. They just sold their India business. India was a market where when they started to invest, there were over a dozen carriers in that country. And there was clearly going to be consolidation. You can't support a dozen carriers. But what happened is Reliance Jio came on the scene in India, deployed a 4G network, gave away the service, and just annihilated the competition. Most of those dozen carriers went bankrupt. AMT entered that market by buying, they started organically, but they eventually bought a company called Viom, which was a JV between Tata and Telenor. Tata and Telenor both went out of business. So you buy a tower portfolio and your anchor customers go out of business, that's not a good thing. And then what they did is they bought additional towers from Vodafone and Idea as part of their merger. Right? So Vodafone and Idea merged to try to improve their financial profile in the face of this onslaught from Jio. But they've had significant struggles since then as well, and basically stopped paying their tower rents. Now, tower rent, that's sort of a foundational asset.
Exactly.
If you're running a wireless business,
it's so good is everyone's got to pay their tower rents. Yeah.
So if your customers aren't paying their rent, that's a sign of how tough things are. So they, I forget the exact numbers, but they recently sold that business. They actually closed it a couple of weeks ago. But they sold the India business to Brookfield for, I believe it was $10 billion, $2 billion. If you were to look at their cumulative investment historically, plus, an appropriate cost of capital, had they simply equaled their required rate of return over their time in India, it should have been about a $10 billion asset. So, in terms of the opportunity cost, they probably lost $8 billion in India, which that's a big number, even for a company of American Tower size.
Yep. So maybe they didn't make the mistake domestically here, but they made the mistake internationally. And good news is tower business models could absorb some big mistakes, given how strong their overall business models are.
Yes.
So I'm going to get back to a topic that we touched on earlier, and I always had the thesis, and that others in the industry did as well. It's kind of an obvious one, that as consolidation took place within the fiber market, as you had less and less owners of fiber infrastructure, that would turn the tide such that those who were the remaining owners would start to have the ability to get commercial terms in exchange for the services that they're delivering that would make for really good business models, make for a lot of value creation. So somewhere you'd reach this tipping point where there'd be few enough suppliers, and all of a sudden being an owner and operator of fiber networks would be a really great way to create value. As we sit here today, the consolidation has largely taken place, yet the manifestation of value creation hasn't necessarily shown itself. And when you think about the important role that fiber and bandwidth play for all the business models stacked on top of it, business models that are worth, countless, hundreds of billions, trillions of dollars, the importance of fiber networks is underneath that. Yet if you add up the value of the companies that own the fiber networks, it's rounding error in comparison to the value that sits atop them. What's your thinking about why there isn't the opportunity to extract more value by being the consolidated owners of the fiber layer of the business? So being kind of the part of Lumen that owns a bunch of fiber, Zayo itself that owns a bunch of fiber. Because once you get past those two, you start getting in situations like you've got Verizon, AT&T, but they've got fiber, but they don't really operate as effectively as a bandwidth provider as those two. And then you have a bunch of kind of regional or difficult situations quite often. What's going on between Windstream and Unity, what's going on within Crown Castle, but neither of those have the vast fiber assets, and they have kind of complication of business. So, what do you think holds back the extraction of value if you own, dense and deep and widespread fiber assets?
That's a terrific question. And it really is the billion or $1 trillion question for the industry. I think there are a couple things going on. Is one, if you look at a player like Level 3 or Lumen, the infrastructure is part of their business, but it's not the whole business. It's not even the majority of the business. And I think while there has been a lot of consolidation, which all else equal should improve the economics of the surviving players, and we don't know what it would have looked like absent that consolidation. So it could very well have been, they could be on a better path now because of the consolidation that's taken place. But for the portion of the business that is not infrastructure related, you might say that there's been new competition or new relevant competition.
For certain there.
In the form of the cable companies have stepped up, or you've seen, increasingly trends where, customers will kind of segregate their connectivity purchases from the services they buy on top. So you might say that there are providers from outside of the traditional telecom industry that are encroaching. Think of Zoom or Ring Central, for example, substituting for phone service. So I think that's been a dynamic that's weighed on broader results. I think within the infrastructure category, and it depends on the company, but I think there's always been some hesitation to sell for fear of cannibalization. Always less of an issue at Zayo because you got it in attractive prices, and that was part of the business. And I think you understood how appealing some of the contractual terms of dark fiber were and whatnot. But for someone like a Level 3, I think it was always or Level 3/Lumen, a bit of a trade-off. Right, concerned, well, if we sell dark fiber to this customer, are they going to buy fewer wavelengths or lit services from us going forward? What's the balance we should strike there?
But even if you focus on the wavelength layer and kind of the transport buckets overall, and I don't have a good answer for this question other than I think the opportunity still is there. But the Zooms require a network underneath them. Anyone who's trading with services that sit atop, say, the wavelength layer, require the use of vast amounts of bandwidth, either directly or indirectly. Shouldn't those who are the suppliers of vast amount of bandwidth find a way to extract maybe a slightly bigger slice of the pie? Because a slightly bigger slice of the pie is almost unnoticeable from the vantage point of the companies above it, but it could be, doubling the value of the companies that are able to do that on a widespread basis. And what would it take for them to unleash that value creation? I think I think that opportunity exists, but it's hard to untap.
Yes. I think once you get above, or my perception has been, once you get above kind of raw infrastructure, the raw fiber, is that competition has tended to keep things in check. You might even argue that prospectively with a player like Cogent entering wavelengths, it might become incrementally more challenging than it has been. I think for dark fiber specifically, with some of the deals that Lumen did recently, like with Microsoft, it seems like they're shifting, perhaps out of necessity, given their financial position, but shifting a bit more to how can we leverage our infrastructure advantage to make some money and keep ourselves afloat. So I think a fair bit of luck there, maybe decisions that you and your team made at level 3 back in the day to put excess conduits in the ground that they could monetize today, plus happen to have, the right assets at the right time, with this AI boom and the need for fiber to interconnect the different data centers. But, it seems like Lumen is taking a bit more of a deliberate approach to trying to monetize dark fiber and embracing that. Recognizing that they have a bit of an infrastructure advantage there that others either won't prosecute or can't prosecute.
I think can't. So I think can't is more the operative word there because, as I understand it, what they leverage is the conduit network that they have. Which that doesn't. No one else really has that. Zayo has it in pieces. Other might have piece parts as well here and there. But in terms of having a vast national infrastructure to connect cities with kind of vacant conduits. They're kind of a unique spot there, even if it hasn't played out the way it was originally intended. But here's my big question on AI. Here's kind of the potential big opportunity, maybe real big opportunity, if you're a Lumen or especially a Zayo. And that is right now what's driving the AI demand is, as is AI in these data centers that are off the beaten path. They're optimized for power grid, and you need to get fiber there. But it's kind of, dozens of locations, not, tens of thousands of locations. So the question with AI is to what degree will significant AI processing need to take place closer to the edge? And by edge, I don't mean, on towers or small clusters in tons of buildings, but edge meaning in geographic proximity to where the use case is. Because if the applications begin to require that, all of a sudden you have this brand new wave of need for fiber and big bandwidth in proportions that are just different than what we've seen in the past. And those who have kind of deep, dense fiber networks and conduit capacity in kind of broad metro and regional situations could stand to benefit a whole bunch. And, when you think about this new generation of AI is so brand new still. It's basically AI's been around since I was, in college, but this generation of AI is really less than 2 years old. So it's really brand new, and where this is going to go and how quickly it's going to go there is, not entirely predictable. But there's a lot of reason to think that the big processing is not only going to be in these remote, big data centers optimized for power. That there's going to be need to take those out to the broad edge, and that could create a huge wave of demand for those who own and control fiber networks.
Yes. I think today, like you said, what we're seeing is because the training for these models is not latency sensitive, firms like Microsoft and Google can put their facilities out in the middle of nowhere where there's ample power, land is cheap, to do the training. But I think what you're alluding to is that over time, as we start to use AI more, as enterprises embrace AI, that latency, those performance attributes become more relevant. So rather than sitting out in Wyoming or West Texas, we'll probably see more inferencing deployments in metropolitan areas, near the eyeballs, near the GDP centers.
Yeah.
Obviously, it depends on the specific use case. It's got to be latency sensitive for that to, for that math to work. But yeah, in that case, you'd think that there would be incremental demand for metro fiber versus the long haul fiber we're seeing today.
I think the latency sensitive is going to have to do with two things. One is these devices, when Apple is coming out and others are coming out with their kind of more robust AI features, they're probably not going to be able to handle that within the four walls of what you carry in your pocket. But it is going to be latency sensitive. So it's going to be throwing out kind of AI requests that need to be kind of made sense of, but done so in that's more customized and more latency sensitive. I think the other variant too, and this one's maybe, when as more and more companies are putting their information into AI to get processed, but it's their proprietary information. They don't want it to be generally available, but it will probably be more frequent back and forth. I'm going to dump kind of new recent data that we have, and I want that to be available for my team within kind of an AI infrastructure. That probably will create potentially opportunities to want that processing to take place in closer proximity to where the company is, perhaps, as opposed to a remote data center. You obviously can still keep it separate if it's a remote data center, but perhaps the back and forth will create latency situations that, hey, it matters kind of where that processing is taking place. So I'm still an investor in Zayo, so maybe that's me wearing my optimistic rosy-colored glasses, but I'm hoping some combination of trends like that produce a lot of need for AI at the edge, which will then translate into a lot of fiber and bandwidth needs at the edge. So we'll see.
Yeah. I think certainly today the demand is long haul skewed. I think in coming years, it could very well be more metro skewed. I think the relevant question, which may be a market by market kind of consideration, is, to what degree, what's the competitive intensity level in a given market? So for example, if you think of New York as a sort of market where there could be significant need for inferencing, just given the size of, given the population, given how big the economy is, given the types of firms that are located here and whatnot. But it's also probably, one of the richer markets from a metro fiber perspective. So that could, kind of beat down the returns that some of the providers might be able to earn on those deployments. There could be other markets where the competitive intensity isn't as rich, or isn't as high, in which case they could earn richer returns on those deployments. One other thing that came to mind is, as you kind of laid out that vision, and particularly for the private data, for private AI, customers not wanting their data sets to traverse the public internet or wanting to keep them on their own infrastructure rather than put them on the cloud. I think that probably bodes well for Equinix over time.
Yeah.
I think one of the investor concerns I hear for Equinix today is that they are not landing these big training deployments. And again, they have a different business model, so that's not surprising. But other companies look sexier in the data center space because they're signing these big deals. But over time, if you believe that enterprises increasingly adopt and rely on AI, and a lot of them have data that they want to keep to themselves, Equinix becomes the logical place for them to interface with their AI vendors. Kind of the same way they interface with their cloud service providers in Equinix. So again, I say Equinix. Equinix, CoreSite, a handful of interconnection-oriented providers.
Equinix is being a prime example for sure.
Yes, exactly.
I definitely agree with that logic. So when you look back over the last 15 years, the aftermath of the bubble and kind of the recovery from there, any big stories that you look back on and say, boy, that was really crazy the way that played out, or anything that was particularly fascinating, whether it be in the form of M&A or in the form of other events that took place in the industry?
Well, I'll tell you, you mentioned M&A. The Level 3 CenturyLink deal was always a bit of a head scratcher to me. Yeah. And I think that, what the company seems to be doing today is try to extricate itself from that. So Level 3, obviously, enterprise-oriented, all fiber network. CenturyLink, sort of a cats and dogs, rural phone company plus the old Quest network. A lot of synergies from the deal, but CenturyLink was not a healthy business at all, and that was apparent at the time. So I think in the couple of years after the deal closed, the synergies that the companies were able to recognize kind of masked a lot of the underlying deterioration at CenturyLink. And they got to the point where they could not cut costs and hide that anymore. And you saw Lumen's stock price at its bottom get down to $1 per share. It had been 20 or so in the wake of the deal. Yeah. But you've seen them try to sell. They sold some of their rural markets to Apollo. That's Brightspeed. They're openly saying that they want to ditch the rest of their mass markets business, which will leave them to a large degree with Level 3 as their core business, and a little bit of Quest mixed in. But looking back, I mean, that deal was it was a head scratch at the time. I remember in the note I wrote when the rumors started to circulate around that, I remember saying that I hoped it was a typo. But yeah, that one was always a head scratcher to me, and it certainly played out as such.
Yeah. Why do you think that deal was done?
Yeah, I mean, I think
that many times.
Yeah, I mean, look, you saw from a CenturyLink perspective, Glenn Post and his team had a playbook where we acquire a bigger company, we cut costs, wash, rinse, repeat, kind of keep that cycle going to sustain our business. Given a lot of the consolidation that had taken place, Level 3 was one of the few opportunities, maybe even the only opportunity they had to kind of continue that process. And from Level 3's perspective, around that time, their growth had started to slow. Level 3 had a bit of a growth spurt before then, where I think they were finally starting to hit their stride from an enterprise perspective. Some of their wholesale challenges were abating a bit. Some old contracts they had that had really weighed on their growth had largely run their course. Their capital needs were moderating. So they were finally growing and starting to produce, some decent cash flow. And that started to stop. Again, it was around the time, I mentioned it earlier, when we started to see the overall market for wireline commercial services slow. And Level 3 was not exempted from that. I think for Level 3, a lot of it was related to MPLS. MPLS, or VPN, which had historically been a growth engine, slowing and then eventually declining. So I think from their perspective, they probably saw that was starting to turn, and that some sort of combination with another large player where they could generate synergies was a way to help mitigate that. Again, I think they misunderstood the risks associated with CenturyLink's business and the degree to which it would be challenged in the coming years. But I think that was the motivation from both sides.
Yeah, the fact that they got cash for half of the equity value of the deal
certainly helps.
That was a driver. So I think there was a bit of a we could take kind of cash off the table. I mean, people there were tired and felt beat up from years prior, and we're looking for maybe not just the personal exit of the management team, but the investors. Like, hey, we could take half of our gain and put it in our pocket. We've come a long way from the company worrying about bankruptcy, and the other half of it, maybe, that we could turn into something significant. But I don't think there was a full appreciation that the other half that they rolled over might go to become worth next to nothing, which for a while there, it was worth, pretty close to nothing. Yeah. A little bit better now, but certainly nothing like when they did the deal. So, I think, if anything, it speaks to, the influences of the team at the time and what their motivation is often comes into play. They're at kind of a different phase of their lives, their careers. They're not thinking about the next 10 or 20 years. They're thinking about, man, look at all the disaster my personal balance sheet went through. Meltdown. I could kind of put that in the permanent past if I could cash out here, and maybe that weighed into the decision. But it did seem very peculiar to me as well. And from a Zayo vantage point, and from a vantage point of being a founder of Level 3, and there through the really good early years, through the really difficult, meltdown years, and the first few years kind of post meltdown when we were getting our sea legs back underneath us. I had a lot of pride in what we created there at Level 3. So seeing that become rebranded as CenturyLink and then later rebranded as Lewin was like, holy cow, and be part of this more traditional telecom type company was hard to watch. At the same time, from a Zayo perspective, it almost like cleared the path for us and said, okay, now we're really the only national and even international player whose business is almost exclusively focused on the broad bandwidth. So, I thought that would be the beginning of boom times for us. And, for various reasons, it didn't play out as clearly that way as I was hoping it would, but it was certainly mixed emotion in which I watched that happen.
Yeah.
What do you think the bright play for Lumen is going forward?
Good question. I think they've got a very narrow path to traverse. They've pushed out their debt maturities by a number of years. They have some breathing room. They've monetized some of the conduits from level 3 with Microsoft and others. So that puts cash on the balance sheet today to help mitigate near-term bankruptcy concerns. Again, like I mentioned before, they're actively looking to sell their remaining mass markets business. So, if they can get a decent price for that, I think that gives them a little more breathing room. I'll kind of set that to the side because it's probably outside of the core focus area here, but there are some puts and takes there to consider. So really, the swing factor is going to be getting kind of the core business segment to some measure of stability, which I think is going to be challenging for them. That business, it's roughly a $10 billion annual revenue stream. And the last 2 quarters have been their worst quarters on record from a growth perspective, declined about 9% on an organic basis.
Wow.
So again, you go back to the
realized.
Oh, sorry.
You mean 9% on an annual basis?
Oh, yeah, year over year, down 9%. Yep. If you go back to around the time that the level 3 deal was consummated, it was probably closer to flat, maybe down a little bit. So a pretty dramatic erosion in growth. And again, it's gotten worse since the new management team took the reins of the business. I think, prospectively, there are reasons to think they could get better from here. Again, you think about wavelengths demand from AI could help. We'll set dark fiber aside because I'm kind of counting the benefits on a present value basis for that. I think they've legitimately made some changes that could be helpful to the sales force, how they motivate and compensate the sales force. But they're in a position where maybe 20% of their revenue is MPLS, something like that, which is declining at a 10% clip or thereabouts.
Yep.
A lot of voice revenue in there, which is at risk. Obviously, legacy voice for obvious reasons, but even like voice over IP, you've got risk from Zoom and Teams and so on. You think about, again, you go back to the overall market. The overall market for wireline commercial services is declining at a 3 or 4% clip. And I think Lumen is roughly 15% of the market. So to think that they could dramatically outperform the market is tough when you're that size. Challenges with Ethernet, which historically was a growth product, has flipped to a declining product, and so on. So I think for them, it's really going to be about fixing that core business, which has struggled so much. I am less pessimistic about Lumen than I was 3 months ago. I think they got more for the conduits than I probably thought they would. Maybe I underappreciated the degree to which there was demand for that out there. But I still think there are going to be challenges turning around the core business.
Yeah, I know Lumen never described exactly what they did there. At least I haven't seen that. But I was presuming that they put a lot of extra fibers in kind of a new conduit and sold some of them off to Microsoft, even though they were low kg about what exactly they did with Microsoft as it related to that. But the timing of announcements, along with the timing of the recording announcements, suggested they put a whole bunch of fibers in the conduit and sold some of them off. But that would imply there's also a large inventory of additional fibers that are being put in that conduit that can be sold to others. So certainly, that could be kind of a cash flow stream that continues for a period of time.
What's funny is when I've pushed them on that, it seems like the fiber that they are putting in that conduit is for Microsoft.
Okay.
Again, at least that's what they've suggested to me.
It might have been exclusive. We want to buy a conduit with fiber in it where all the fiber belongs to us. That certainly could have been the deal.
Yeah. And in fact, and again, this is all kind of secondhand stuff, but my understanding is the deal contemplated 2 conduits, sort of one for the fiber and one for maintenance. So if in the future they wanted to pull like a next generation of fiber, like say hollow core fiber, if that becomes a thing, like they could pull it through the second duct and then pull the old fiber out of the prior duct or something along those lines.
So let's go back to Crown and Crown's fiber business. What do you think happens with their fiber business?
That's a great question. There was a report a week or two ago, I think it was from Reuters, suggesting that there were bids or interest from Zayo and TPG. So Zayo, not surprising, Zayo would be interested. I mean, I think a lot of the companies Crown acquired or companies that you would have liked to acquire at Zayo, but they outbid you, right? So I think
that's no question about it.
Yeah.
I coveted a lot of those companies, and at the price that they were paying, it was hard. In fact, I tried to outbid them for Light Tower. I think I'm glad that we didn't succeed in that, because we matched pretty much their price and maybe forced them to pay a little bit higher than they were intending on paying. But if we would have won it at that price, I'm not so sure that would have been a good thing for us or not. It felt like it was the right thing to do at the time, but just barely. It's kind of one of those deals where you're like, I don't know if I want to win this or lose it at this price. So I didn't feel too bad losing it at that price. But it was very complementary asset, would have given us that much more concentration in a lot of key markets.
Mm-hmm.
But Crown was prepared to pay higher multiples for all the deals they did than we were prepared to pay, and it was painful watching that happen.
Yeah. So I mean, Zayo and Crown Castle Fiber together, really interesting combination. Sort of a pure play national provider that no one else would be able to replicate. TPG, a financial buyers, they'd have their own motivations, presumably try to flip it to Zayo down the road.
Sure.
But it's interesting. So this article, so Crown Castle is going through a process to try to figure out what to do with these assets. And at the end of the day, this Reuters article suggested that the combined value for small cells and fiber solutions was in the $8 to $10 billion range.
Yeah.
Which is pretty shocking, because if you look at Crown Castle's quarterly supplements, I think the cumulative price of the acquisitions plus organic investment in the time since, I think it's $17-18 billion.
Yeah, high teens is what I understand.
Substantially that. So if the Reuters report is to be believed, and it's a credible source, we don't know all the nuances, but I mean that's a pretty stunning gap in value. Yeah. And you can never tell exactly what the market is implying about the value for one segment versus another. But I think if you take reasonable multiples for the tower business and try to tease out what the market is saying for the fiber business, the market is also ascribing sort of a mid to high teens $1 billion value for the fiber unit in aggregate. So it's a really interesting disconnect. And I think from Crown's perspective, it raises the question, okay, strategically, maybe we don't want to be in this business anymore, but are we willing to take, an $8 billion or $10 billion markdown versus what the market is giving us credit for to do that? It's also a bit of a funny situation because their fiber business doesn't generate much in terms of cash flow. So it's a drag on their ability to pay out a meaningful dividend, which has historically been Crown's primary means of returning capital to its shareholders. But given the accounting, the fiber business does contribute a decent amount of AFFO. So in other words, the stated maintenance CapEx is very small. The actual CapEx is very large. There's a gap between the cash flow and the AFFO. So if they sell the fiber business, their AFFO is going to go down, but their cash flow probably improves. So that their dividend payout ratio relative to AFFO gets worse, but relative to cash flow gets better. So it's a very strange situation. I would have said, if they could get low teens, mid teens type value, billions of dollars of value for these assets, that it makes sense for them to pitch it. I think investors would generally rather Crown be a pure play or close to pure play tower business. But with that sort of gap in value, it becomes a much more difficult decision.
Yeah, difficult decision, but the gap in value might be a perceived gap as opposed to a real gap. And what I mean by that is, take a couple steps back and think of Crown operating that business, that fiber business. Mm-hmm. And what are they operating at this point? I mean, they're a tower company that has this fiber business that, they've been unable to make that kind of truly a strategic business unit. They really didn't have people running it as a business unit. They had kind of a sales division and a network division that rolled up to like a tower person who was doing other things as well. So they never really built kind of an operational business model. The small cell dynamic didn't play out. As you said earlier, Verizon was reluctant to rely on, on Crown for a greater portion of their underlying infrastructure. There's a little bit of a love-hate relationship between a Verizon and AT&T and the tower industry. So, now they're starting to view Crown as a bit more of a competitor. So they've probably, whatever business they were directing to others, they probably directed away from Crown. Big enterprises, aren't going to buy their big bandwidth solutions. If I'm a Morgan Stanley or a pharmaceutical company, I'm be like, okay, I could buy from a Zayo who does this for a living, a Lumen who does this for a living, a trusted name maybe like an AT&T, or I could go to a tower company. Well, maybe for where I absolutely have to, but for the most part, that's not going to be a comfortable customer relationship. So part of this comes down to whatever the innate value of those assets are, they're worth far less the longer Crown owns them. And the tough part for Crown, it's not like someone's going to pay you, extra because they could do a whole lot more with those assets than you could do. So from Crown's perspective, I would think one, whether they realize it now or not, they've got to divest the business. It's not going to maintain whatever value it has now under Crown. So if it's worth, 9 or 10 million, which is given what they've done with the business, that's not an unfair price. It's going to go down in value the longer they own it. Even if the value of a fiber-based businesses in general goes up in value, it's going to become more of a distressed asset. So if they could roll it into something where they want to keep an equity stake and play for upside that way, that might work. But, I don't think even if it's hard to part with it at that price, even if your AFFO math, because a lot of that is kind of, shorthand ways of implying what the true value is. But those shorthand ways don't always work. They maybe work with kind of multiple metrics, but they don't work on cash flow metrics. If they look through that and say, what really is the right thing to do from a cash flow standpoint, and the rest of the metrics will find their way to a good spot, it's got to be divested. There's really no other obvious answer, but it's a hard choice to make.
For them, that there is a new CEO and an activist and some new board members could make pushing them over that line easier and more likely than it would have been in the past.
Yeah, no, you've seen that in a lot of industries over the years where a company has to make a really hard decision to divest something that they should have never have acquired. And when they divest it, it's kind of like, okay, I'm giving something away that I know should be worth more money, but there's really, sitting around waiting for someone to pay me that isn't an option. I need to just move on. And maybe they reach that decision 2 years from now as opposed to now, but sooner or later they're going to come to that decision. I don't think there's another alternative, but it will be interesting what happens. I mean, this will be hard for a financial buyer. And it's hard for Zayo right now too, because Zayo's got, it's got its own balance sheet kind of gymnastics it's got to jump over. It is hard. I believe running these businesses is easier when you're on the outside looking in. Like, oh, you just do this, and the business dynamics work out. But when you're running one of these business models, unlike towers, they are nuanced, they are complex, and some things that seem like the more obvious things that you should do aren't necessarily the right answers to do them. And it's interesting that, I don't know, we go from something where they've got an investment in the business that was maybe $17, $18 billion. And now they're looking and saying, okay, what happened? How did I destroy $8 billion over the past X number of years? You look back and say, I don't know how that happened, but clearly it has happened.
Yep.
So, but I don't think it's a sign that the fundamental value of those underlying assets, isn't there. I think it's just those assets are in the wrong hands. And, people run Crown Castle know how to run a tower business, but, running this type of business, particularly with the changing dynamics relative to small cell, didn't work out as well. So here's a seed to plant with you that, probably won't be relevant for a couple, 3 years, but, I've been spending a lot of time in the quantum world,
Okay.
as we know, and quantum is a little ways out there before it will go through what AI is going through right now. That is before it starts to really get out there in a broad commercial sense and starts affecting kind of everyday businesses. But it's going to get there, and there'll probably be a few events not unlike what we're experiencing with AI right now, where there's kind of a cross the chasm kind of event.
Mm-hmm.
Probably starting with the event itself will be in the quantum computing realm when that happens. But in the meantime, there's a lot going on with quantum sensing, and there's a lot of how do we be ready for quantum computing when it comes to encryption and kind of the networks associated with encryption. So back when the internet came on the scene, the first thing we did with the internet is we put them over traditional communication networks.
Mm-hmm.
We used things like dial-up modems, DSL service, SONET service to carry internet traffic. But eventually, internet traffic started to be carried in a more native basis through Ethernet networks, straight over wavelengths, and even using dark fiber. So kind of getting rid of the telecom overhead and talk more native Ethernet. The same thing is going to happen with quantum. So quantum, when you think of quantum sensing, which is a big category, quantum, that really starts to look like a Internet of Things in our telecom language, a quantum Internet of Things where there's devices. Some of them are radios, like on cell towers. Some are different type of sensors on cars or other devices, GPS systems. So there's a bunch of quantum devices out there, a bunch of quantum computing will start to proliferate. Well, those quantum devices are going to communicate with each other, not using traditional, conventional networks, but they're going to use it. They want to communicate native quantum. So through quantum communications, and that will kind of be a whole new wave, 10 years from now, of kind of networking that is tailored to a whole new generation of technology. So you're still of the age where you'll be covering that, and we'll be able to talk about that whole new wave of communication networks that are optimized for the quantum future, which would be pretty interesting.
Yeah, something to look forward to.
Yeah, you'll have to be a little patient though. It'll be fun. So, any other big memories from the last, particularly in the fiber world, since that's kind of my
big memories.
So, any other big memories that?
Well, I would say it's relatively recent, but I think a really interesting story over the coming years is going to be what Cogent does with Sprint.
Yeah, let's talk about that for a second, because I often and still believe you guys are getting that wrong by a lot.
Okay.
Because the fiber they got from Sprint is old fiber with no ability to put,
so it's older than me. Yes.
Yeah. And no ability to put something else in there unless you want to kind of, spend billions of dollars digging up, lots of different paths. And putting a modern wavelength system on old fiber is significantly cost disadvantaged. So the fact that the fiber, quote unquote, is free means nothing. I mean, fiber everyone has is free because that got paid for by, the money that was spent in the late 90s, early 2000s, and, has long been wiped out of everyone's, balance sheets. I mean, you can just see that in the market cap of the companies. So the advantage of having, quote unquote, free fiber that is that dated does not translate into wavelength systems that could keep pace with other wavelength systems. It's there's a big cost disadvantage, and I think you can fool yourself for a period of time on that because the association of capital to EBITDA is so disjointed if you don't track it carefully. That is, you spend the capital to light up a new wavelength system, and any way you price the wavelength translates into EBITDA, but it doesn't translate into a return on capital. It's just hard for anyone to do the math unless they're really convicted to do the math. But I think if they really do the math, they're going to be throwing good money after bad when they keep trying to light up new wavelength systems to sell wavelengths. They're not going to be able to get, truly the long-term revenue contribution and cash contribution from that wavelength to pay for the equipment that they're deploying to create the wavelengths. And I think they may need to go through a couple cycles before they realize that and have no place to hide. But I can't imagine they're going to keep up with that for very long. I think at some point it's going to be hard to get away from the math. So, but somehow it seems like the analysts somehow are seeing something different. I mean, that seems so obvious.
Yeah, it's funny. The fiber is old. I saw a study that Corning did that suggested it remains in good shape, particularly in light of its age. Nothing extreme in terms of fiber cuts, quality's still there. I mean, Cogent, they're selling waves today, right? So it works technically. I think I think the point you make about it being older and having a cost disadvantage, on an apples to apples basis is correct, right? You need more regeneration points and whatnot. That adds an ongoing OpEx and capital burden. But at the same time, I think from Cogent's perspective, there's a lot of existing infrastructure they can leverage to make it work. Beyond net data center footprint, customer relationships. From a balance sheet perspective, they're in a good place. Pricing is less of an issue. In other words, they don't have to reprice a book of business the way that Lumen or Zayo might have to worry about. I think it's an interesting opportunity for them. And aside from the waves angle, which is probably, again, it's the biggest part of the Sprint deal, but the way that the way they can tease out some of the other assets and monetize them is interesting too.
And Dave Schaefer, the CEO, is fantastic.
He's brilliant.
Teasing out value.
Absolutely brilliant.
I mean, I've always admired him in doing that and modeled some of what we did after him. Like if he can make money doing what he's doing, we should be able. And so, but you got to get really close to your assets, which he knows how to do and how to monetize those assets. But I think the big opportunity in wavelengths, I think the relationship, wavelengths can be priced in a way and will be priced in a way, as each modern system gets deployed, where if you're working with this legacy Sprint fiber, it's not a question of you making less money than someone else. It's that you can't recover your capital that you deploy, that the math just won't work. And that, yet, not unlike what I described with the small cells, you have to really be paying attention to details to see that. And you got to be looking over a 5-year period. But my guess is, you'd say, okay, how much revenue can I really generate from this wavelength system that I just spent, millions of dollars to deploy, tens of millions to deploy? There's not going to be it's going to be upside down. If it's not already upside down, if the destiny is it'll be upside down, you just won't be able to compete with that infrastructure. Is my intuition. Now, it could be wrong, but to me, that seems like a fairly safe conclusion, and it's sooner rather than later. This isn't a 10-year. This is if it's not already the case, and they just don't realize it. It's imminent. It's just one wavelength system away from not need to spend a lot more capital per wavelength, and the market pricing doesn't allow you to recover that capital. But if I'm wrong, it wouldn't be the first time I'm wrong.
Well, we'll see if this is what trips Dave up.
Yeah, but Dave's such a clever operator. As long as he's there, I always thought his is one of the hardest positions to replace. Like when he's ready to not do that anymore.
No question.
The way he runs his business is not the way most people run a business of that scale. Because if you're not extraordinarily intelligent, which he is, and extraordinarily focused on, I'm going to really understand how to extract value out of these assets I have. He's able to do that, and I don't think others kind of can play at that level. It'd be really hard to substitute someone in for him as his successor. Is my guess.
Yeah, I mean, Cogent is Dave. It's Dave's philosophies. It's his operating methods in a way that I've never seen in another company. Mm-hmm. So key man risk exists at Cogent like at no other business I've found. And replacing him, good luck with that.
Yeah, exactly. Probably have to take a step backwards before you take a step forward, but who knows? Maybe find a good exit when he's ready to exit through an acquisition, and that becomes someone else's problem.
Yeah.
Well, great. Well, Nick, it's been great having kind of a journey that coincided with yours, and I've always valued your insights and your reports, and your objectivity, your thoughtfulness, your ability to articulate yourself in writing extremely well. That's been something I've valued. And I wanted to feature you on this so that other people can learn the kind of value you bring to the table. And hopefully, they want to leverage that, and that turns into a more robust future for you as well. So thank you so much. And I'm glad our journeys, cross paths the way they did.
Yeah. Well, thanks for the kind words, Dan. Again, thanks for having me. I think, looking back, Zayo was probably perhaps the company I enjoyed covering the most. Interesting business model, interesting cast of characters, a lot of data to work with, a lot of controversy. And I think the way, like you said, the journey together, kind of the way that your IPO corresponded with when I was trying to sort of launch myself as an analyst, it certainly intertwined, and I think did a lot to kind of introduce me to to our client base in a better way and to the market. So thank you for that.
Well, thanks. Yeah, no, it was. I was always proud of what our industry did, even if at times our industry got upside down and was chaotic. But the fact that this grouping of dozens and dozens and dozens of leaders and the people around them navigating through from when there was just AT&T until present day, I did want to capture that broader story. And the Zayo journey, it's funny you described as, I think you said controversy or whatever. I didn't really, certainly there was, we were doing a lot, but we had a steady value creation. We invested $1 billion in equity from inception, and that billion, when we actually was worth $8.5 billion. So if you look at the path of value creation, whether we're public or private, small or big, it was pretty steady along the way, and turned out to be a really good outcome for the investors who backed us and the team that made it happen. So I was proud of the overall outcome as well.
Great.
So great, Nick.
Okay. Thanks again, Dan.
Enjoyed it. Look forward to catching up live before too long.
All right. Take care.
Take care.
Thank you for listening to this episode of The Bear Roars. If you enjoyed the episode, please like and subscribe on your listening platform. This podcast was produced by Loud Bear Productions and edited by Courtney Caruso with support from Kendall Weinberg, Emily Reed, and Gibson Siegert.